JJ the CPA here. Hope you're doing well. So we have completed 3 weeks of tax season. I want to talk to you about what's going on right now, what to expect. Got a few notes for sole proprietors, those that are filing Schedule C, S-CORPs, partnerships, business owners, as well as those that have residential rental. January 23rd, though, Monday, IRS is opening up e-filing season, so we are off to the races. Now is the time to get your stuff together and get after getting your return filed so that you can start planning for 2023. Now, for businesses that have paid more than $600 out in 2022 to an individual for legal services or for personal services, then you need to send that recipient a 1099 NEC on or before January 31st and file that with the IRS. I do want you to note this, that if you paid somebody by credit card, you do not include that amount in that dollar amount that you're reporting on the Form 1099 NEC, because that person, that business, is going to get a 1099K for those dollars amounts. So if you paid by check or cash, then those amounts that are over $600 aggregate in 22, well, that needs to show up on your Form 1099 NEC and get it to them. If you don't have the information, you can send them a Form W-9 that they complete to give you their name, their EIN, their address, etc. Get prepared now for 2023. So if you're having to do this and chase people down, well, then send these Form 1099s out to these individuals, get the deadline met, but then get after those that you're going to need that information from for 2023 by giving them a Form W-9 so you don't have to chase them down this time next year. Now, for employers, it is time to get out your W-2s if not already, but you've got to get that filed also with the IRS along with that transmittal Form W-3. For employees, if you haven't received your Form W-2, we'll be looking, it should be getting to your mailbox by early February. If you're not seeing it, then don't wait around. Call that employer and see how you can get a copy of it so you're not delayed in getting your own tax returns filed. Now, speaking of wages, if you do expect to owe over $1,000, note this, the IRS does expect you to pay estimated tax payments. You potentially are looking at penalties and interest come April 18th when your tax is due. With that being said, if that is the case either for last year or you're expecting that to be the case in 2023, then you need to adjust your withholdings, meaning you need to have more tax withheld. The IRS has provided a wonderful resource. It's a withholding calculator. I'm going to give you a link to that in the body of this video that helps you determine how much you should have withheld, taking into account everything in your tax picture. A number of things I'm going to be visiting with you about. I'm also giving you links in the body of this video. Did you want me to note, though, that for those that have kiddos that are students, whether it's college or high school, and they've got a job, if they're not going to make more than $13,850 in 2023, then you should have them complete a new Form W-4 for 2023 to claim exempt so that there's no federal tax withheld. It might be the same for the state if that applies to you. No reason to have these taxes withheld if all they're going to do is get a refund this time next year. Now, they're not going to necessarily be exempt from Social Security and Medicare, but on that federal tax, they could be exempt from having any withholdings related to that. IRS recently announced for those that are storm victims in Georgia as well as Alabama, they have also extended their due dates to May 15th, similar to California. Do want you to know that that is the individual and some of the business due dates between now and April 18th all have been extended to May 15th. I'm giving you a link, so if you happen to be in those areas, I hope you're doing well, but check it out to be sure that those exact due dates for what you're inquiring of do apply to you. The IRS has announced a free e-filing system program that you can go to. All I would say is that if you're using that, it's probably really for the simple, maybe for the student. If you are preparing on your own, be cautious of this, that if you've sold stock, you bought a house, you have itemized deductions, you have a small business, that really might be the time to hire a tax professional. And if you don't have one, find one soon, because the closer we get to April 18th, they're going to be harder to find. Also, what I want you to keep in mind is that there is a saver's credit. The IRS recently reminded us of that. This is for those that don't have high income And the IRS literally gives you $1,000 per person based on the amount that you put into your retirement. So be sure that, especially for those doing it yourself, that if you fall in this category, look in box 12 of your Form W-2. If you have any kind of retirement withholdings in there and you have that low income, well, then be sure you're qualifying for it if that's the case. Now, you do have to be at least 18. You cannot be a college student or a dependent to be able to qualify for that. Do want you to really pay attention that the employee retention tax credit, this is for employers, is still alive and well. Now, what I mean by that is that you can still go back and get this credit. Now, credit may be something that you think, well, that's just related to taxes, but it's a refund at this point that you get back. It's up to $26,000 per employee for wages that have already been paid from March 13th of 2020 through September 30th of 21. And if you've got that, you need to take a look at it. By the way, I've got a seminar, A to Z, do it yourself, pretty reasonable. I'll give you a link to that seminar that you can get instant access to, and I show you how to do it all, including how to prepare that Form 941X, which is the form that you file with the IRS to get that check. Sole proprietors, self-employed, unfortunately, you don't qualify for that unless you had W-2 employees yourself. Now, for small businesses, really take note of this. Many are going to get their credit card statement here in January that's going to include charges at the end of the prior year. So be sure that you're picking up those expenses in 2022 because you get to write off expenses for your business based on when you charge your credit card, not when you pay the credit card off. So when you're getting that credit card statement, it's definitely going to have dates in 22 as well as in 23. So be sure that you're getting all the deductions that you deserve and falling into that right year. For sole proprietors, what you might be surprised with, especially for the new ones, is how much your tax is. That net income is subject to 15.3%. So for 2023, you might really consider an S corporation. I'll give you a link in the body of this video, further details and why, but it would save you the 15.3% tax. That's an additional tax on top of your regular income taxes. So expenses not to forget about is that home office, the mileage. Now, if you do have a home office, you potentially can count your mileage from the time that you leave your home related to your business. Remember, meals, your cell phone, these are things that you can tax deduct. If you have assets that you bought in a prior year, let's say a computer or a phone, supplies, furniture, these are things that you can then write off when you start using them for business. See, the IRS requires actually two things to happen with a business to be able to write off assets. Number one, they have to have bought it. But number two, they have to have been using it for their business. So if you've bought these things in prior years before you started your business, and now you are using those for business purposes in 22, well, then you get to write those off. So be sure that you're gathering that up. Also, go through your personal bank account as well as your personal credit card statement and be looking for those little things that would qualify as a tax deduction. So dues and subscriptions, things that are related to travel. I think I mentioned meals. Last year, you get to write off 100%. Now in 23, we're back to 50% on that. But there's going to be probably expenses maybe you didn't think about. Also, I want you to start thinking about not paying for things with cash because you want to have record of these payments. You want to have the receipt, but then also show that you paid for that. Any cash that you get, you really just want to go ahead and deposit it, recognize that income, and then have your money going towards expenses. Also, with sole proprietors, if you've paid your kids, those are under age 18, then you don't have to withhold any kind of Social Security or Medicare taxes. And if you didn't pay all that much, meaning below that standard deduction I mentioned earlier, well, then they're not going to owe tax either. So this is a way that your business gets a deduction and they're picking it up as income. Maybe it's created income. They can then put money into a Roth IRA, but be sure that you're picking up those expenses. Now, we know that the tax documents are all going to be in your mailbox or in your email within the next week by early February. That's the statements that you get related to your mortgage. But with that, make sure that you're writing off your real estate taxes, sometimes on that mortgage statement, the Form 1098, It doesn't always reflect it if you didn't pay for your real estate taxes through escrow. So that is something that you can deduct on Schedule A as an itemized deduction. Also be gathering up your charitable contribution receipts. You should be getting those letters from those organizations that you gave to last year. But be sure of this, and be very sure that that receipt, that letter, indicates on there that no goods or services were provided. See, the IRS technically won't allow the deduction at all if it doesn't have it on the receipt. If you gave away money to various organizations over $250, they're going to be able to send you that receipt. So if you're not seeing those, get in touch with those organizations so that you can get on top of getting that in your tax file and get the deductions that you need and deserve related to being charitable. Now, for S corporations and partnerships, I want you to note that the tax return is due March 15th for 2022. Now, you can extend it to September 15th, but remember, an S corporation and a partnership, they don't have any tax up at its level, at least not at the federal level. And so whatever that net income is, regardless of how much money you pulled out, that's what you're going to pay tax on at the individual level. So if you are going to file an extension, well, then be aware of what that number is going to be. That's going to impact your individual tax return. So there's no reason to wait on getting your business returns done. S-Corp owners and partnerships, figure out where that's at. One thing to consider with the March 15th deadline for S-Corps and partnerships, if you have an employer plan and you're doing an employer match, those dollars do need to get contributed on or before March 15th. However, if you extend your S-Corp or your partnership return, well, then that gives you all the way until September 15th to be able to do the employer match. So we have a number of clients that even if that business return is done, we will file the extension, and then soon after the March 15th deadline, well, then we'll e-file it. But then we've bought that small business time to be able to make that employer match all the way until September 15th. What you want to really do is set a goal for yourself that your business return and your individual return is done by the end of February, because you're going to have everything by mid-February. Get after it, know where you stand so you can start planning for 2023. Now, for those that have residential real estate and you are doing that as an investment, you're writing it off as rental property, that would go on Schedule E, page 1. Don't forget to depreciate that house. Many will. Also, when you get that mortgage statement, as I mentioned earlier on the individual, always note this, that typically is not going to reflect the insurance that you're paying on that residential rental. So make sure you're deducting the mortgage interest, real estate taxes, as well as then the insurance. And then you as well should be looking through your bank statements. Where were there Home Depot receipts related to that? Repairs, utilities, mowing, maintenance, many expenses that you might have had throughout the year. Make sure you're gathering those things up so that you can get that full deduction related to that. Thought I would also mention you do need to keep your tax records for 7 years. The reasoning for that is that you want to be able to prove your income and your expenses. Now, if you have assets that you're holding on to, a home, stock, then you want to continue to keep the receipts or any documents related to your purchases so you can substantiate your cost basis. And then when you sell it, then you're going to take your sales price, subtract out that cost basis, only pay tax on the gain, but then you would want to keep all those documents related to that for another 7 years so that you can back that up. Small businesses, you're going to need bank statements, credit card statements, where you can show that your business actually paid for those expenses, but you still need to have the receipts to back up what it is that you spent. See, the IRS, they want to see the bank statement and the credit card statement, again, to see that your business paid for it. But that's not alone enough. They've got to be able to see the receipt to see the detail. It's not an obvious to the IRS that Office Depot is a business expense. So even though your credit card has a line item that says Office Depot, without then the receipt, the IRS upon audit is not going to allow that. So you got to have all of that and keep it for 7 years. Well, I have an expanded near 4-hour instant seminar with a boot camp for tax season 2023. I'll give you a link to, as well as a link to my employee retention tax credit seminar, both instant access. I got a package deal for you. Also, be sure to catch out my live. I go live to do Q&A. So As many times as I can during tax season, I'm going to be here to answer your questions live. So look forward to that. Also, in the next 48 hours, depending on when you're watching this, I've got a group 51. What this is a way to have some one-on-one contact outside of my client group. I'm not taking on new clients, haven't since 2018, but with Group 51, it's a select group of tax professionals as well as small business owners that I do a monthly seminar. What I provide is details of what I share with my client, but don't put on YouTube. Keep in mind, I'm going to be doing a weekly update, so every weekend I'll be coming out with a video recapping, so stay tuned for those as well. Well, with that, if you made it to here, I'd love it if you'd subscribe. I'd appreciate your thumbs up. And then, don't you ever forget, you've never met a CPA quite like me. Have a great one.